If you're Ugandan and want to buy part of freshly issued Kenya Airways shares in what is called a right issue, that window is now closed if you're not a shareholder. However, there is still one chance left if shareholders do not assume the extra shares allocated to them. The challenge that is keeping away many Ugandans is because you have to register at the Nairobi Stock Exchange if you are new. This is the issue that requires a solution. Kenya Airways is looking for $3.5 billion to expand its airplane fleet from 35 to more than 100 in 10 years. This undertaking, however, comes at a turbulent time, economically speaking.
Fuel is actually 45% of operating cost, which is very high. When you're in a business, when one item of cost is 45% of your cost, and it is so volatile, hedging is no longer a thing that you do out of speculation or something nice to do. It is something you have to do from a risk management perspective. We have a good hedge book. 80% of our fuel for the next 12 months is hedged, and then 50% of the next 12 months is hedged.
The company also plans to take on competition from the big global players through going where they can't go.
The Emirates, the Etihads, and so on will always be a competition for us in the capitals of Africa where you have huge populations. For example, Entebbe, Nairobi, Cairo, Johannesburg, and so on. But if you go into the central part of Africa, where our main focus is, inland Africa, where you're likely to pick 100 passengers at a time, it doesn't make economic sense for them to be able to fly to those destinations.
India and China to Africa, and vice versa, holds enough traffic, the airline claims, to keep the airline afloat, and explains part of the fleet expansion and the $3.5 billion expenditure. Samuel Setumba, NTV Business.